If you really are going to build new types of banks and really transform them and build better banks, it's going to be easier to do it outside of a large organization than inside of a large organization. And until very recently, that wasn't true. It's only been true in the last few years that it's been possible to essentially build a bank from scratch in the sense that you no longer require the big distribution channels.
Welcome to this episode of Banking on Air. I would encourage everyone who's listening at this point and to those in your circle to please go to Spotify, Apple Podcasts, or any other service that you might use and search for Banking on Air on your favorite platform, subscribe, and stay with us on our journey. So today I am delighted to be joined by Jeremy Takle, who's the co-founder and CEO of Pennyworth. And with Jeremy, we're going to be discussing what it's like to be an incumbent and then shift over to the other side, as it were. So a challenger to your own challenge. A story potentially of David and Goliath. A story, if you're a football fan, of two halves. And to find out what it's like to go from the incumbent side to creating your own digital bank. One in the US, one in the UK. And what that journey has been like. The challenges, the successes, the nights that you wish that you hadn't done it. No. And how that's working in terms of partnerships, regulation, funding. It's been an amazing journey. So welcome, Jeremy.
Hi, Helene. Thanks very much for inviting me to this.
It's great to have you. Jeremy, I mentioned early on that in that introduction that you have done this in the US and you're doing it in the UK. And I said that you've done it for an incumbent and now on your own. So maybe you can help us to set the scene a little bit about what it was like on the incumbent side.
Yeah, sure. So I spent most of my career at Barclays, joined as a graduate and was there for about 24 years. And I had a slightly unusual corporate career in the sense that I got to spend a lot of that time around the world building banks. We built a credit card bank out in Scandinavia, built a de novo retail commercial bank out in Asia, similar sort of transformations and builds across Europe and Middle East. Now, I think one of the things that was true up until very recently, and I would say almost the last few years, it hadn't been possible to build smaller businesses or build your own bank in the same way outside of being inside a large incumbent. And because there were lots of scale requirements. So when we built a bank out in Asia around 2007, 8, 9. It was a traditional large-scale business with big distribution channels. We had an ambition of growing business with up to 50 branches. It required a big data center build, which we put down in Singapore, that would store our entire tech stack. And then, of course, we put together a team of around 300 people to actually run that operation and build all the tech platform and then launch the business. And so it was always a scale business. I guess there's an element of scale in banking always because you need to aggregate enough deposits to lend and you need to have a wide enough distribution of lending to really make the balance sheet work. But that isn't the biggest driver. It wasn't the biggest driver of scale. It was really that front end and back end distribution requirement. And so for me, there was no other option when I looked at the idea of building banks to do that within a large organization like Barclays. And I was lucky enough that Barclays was global and the skills and knowledge about building banks and distribution channels and new platforms was there inside the organization. You could learn that. So I got a career where I learned how to plant new flags in new markets and build retail and commercial banking businesses across the world.
Isn't it? Can I just ask you a question, Jeremy? Because usually, and we said this on an incumbent side, you have the skills and you have the tech capability within it, but generally it's the culture that gets in the way of something actually happening that's innovative. And when we think back to what you said about 2007, 2008, when you really a pioneer, how much the tech has changed, how much the scene has changed. But then moving with a large incumbent where legacy, cultural legacy gets in the way, how did that play into being able to do things, plant the flags?
Yeah. I mean, it was very clear that what we were doing in the periphery of Barclays, out in emerging markets in Scandinavia with the credit card bank, building Barclaycard around the world, was only possible essentially on the periphery of the mothership. It wasn't possible in the core home market retail bank because there you had all the legacy, you had all the build, and there wasn't the same amount of innovation possible. And so inside big banks, that's really where you're able to do these things and you're set up perhaps better to do so. As we were building out our Indonesian business, we put together a cross-disciplinary team. We had all of the functions focused on that one goal and was able to build a business. That's very difficult inside a mature home market business like Barclays is in the UK, which is highly siloed, very mature tech platform distribution, and innovation is really only incremental, and very little innovation actually happens in the core product businesses. So it was really a function of the fact that we were able to be out in the peripheral part of the bank, or entering new markets, planting those flags, if you will, that enabled us to really build out. And essentially you were expanding in a proven model. So it was the credit card model within Barclaycard, or the retail and commercial bank within your UK European business, that you were able then to export into Africa, into Southeast Asia, etc.
But you did also do it in the US, which I think was, if you think about what you're taking on in terms of the regulatory environment, the volume, the resistance at that time, is obviously changing now and changing quite rapidly. We've seen some recent announcements from the OCC and the FDIC. But what was that conversation like when you thought, we'll do it in the US?
Yeah, and that's probably the first example of us trying to do it in the way that you would set up a digital bank today, on a new platform with a new brand, playing the challenger model rather than the incumbent model. And so that carried its own challenges. I would say the challenges were mostly internal, not external. And that's partly just a consequence of what we were trying to do. So in the US, Barclays is pretty much only known as an investment bank, and that it has a credit card business that is predominantly co-branded. It's a partnership card. So they issue American Airlines card, JetBlue card, etc. So they're predominantly known either as an investment bank or as sitting behind the scenes powering other credit cards, and had no real own brand consumer presence in the US. And so the first challenge essentially was to design that business and what it would look like and what products you'd be offering to the marketplace. But also we decided that we would build that on a brand new platform. So a microservices infrastructure, event-driven, API-based infrastructure that we would build that on, as you would if you were starting from scratch with modern infrastructure. But we had the existing credit card business. We had the existing processes sitting behind that business. We had a deposit book that was run essentially to help fund that credit card business. And there were processes behind that. And it sat inside its own, and this is the big thing I think in the US that was helpful, its own bank holding, its own bank company. So we already had our license. And so being able to use what infrastructure was already there enabled us to immediately deploy balance sheet inside our business. And so very much like Marcus from Goldman Sachs, we were able to use what we'd inherited in terms of deposit license to then launch a digital consumer bank in the US. The challenge then, of course, was to convince first internally the organization to take what had been a credit card monoline and turn it into a consumer banking business. And so getting buy-in from the group executive about how to do that. There were, of course, an element of regulatory challenges in terms of just also making sure that the FDIC and the Fed, who regulated Barclays predominantly in the US, were comfortable with the diversification that was happening inside the business. But the biggest challenge we faced was, even though we were in a remote market, away from the mothership, and launching and essentially proving a model where you could acquire in that market mass affluent customers, and we were taking these away from the likes of Chase and Wells and others, proving that you could actually win with better pricing, better experience, and a new challenger brand, and win that sort of, if you will, that really great business, that soft underbelly of business from the main banks. Even though that was doable, you still had the same challenges of a big parent with siloed structures. You would have to actually walk around and convince every single function to bring themselves to bear on this problem, even though you had group executive mandate. Can we have the technology partners and engineers that we need to develop this? Can we have the credit risk mandate and staff to help us do this? Can we have the marketing and brand permissions to build this? And whilst we were obviously trying to do this in a scale agile way, each of my product managers would have a full stack engineering team, credit team, marketing team sat around them and could work in agile sprints to actually develop and iterate the business fast. Then we would experience things like suddenly all of our engineers would be pulled away. In this instance, would be centralized in one big campus in a completely different state, which meant essentially reducing the staff here and hiring new staff over here, but in no way allows you, therefore, to continue to work as an agile team. And it's those types of understandably functional strategies of reducing cost and trying to drive synergy through the function is really at odds with the ability to run as a scale agile business and iterate and learn together as a team. And I would say that outside of the big banks, you have these skills, but inside big banks, very seldomly do you, outside of the IT department, actually have the product management, product owner skills to be able to do that. And so that was actually something that we were able to put together, but it was a very rare skill set, not very well understood.
As you were talking, I was exactly thinking. Now you've experienced a little bit of what it's like for the fintechs to work with the incumbents and as the pieces move internally, but also then why there's a need for organizations, for example, like Vacuum, to work in partnership with the incumbents to produce their digital offerings. Because then when those instances happen and teams disappear, we already have a team that's in and we have been working in partnership alongside, and we can up the number of engineers, for example, or dial it down as required. And I think we've matured a little bit in the last few years into people accepting that space, but it does highlight both the challenges, fintech to incumbent, and then the need to partner with somebody that can be part of your build as well. So I would imagine that some of this experience is what drove you, she says, as if it drove you to a place, not to drink, but to a place, drove you to want to take the experience and set out on your own to do that, but do it on this side of the pond.
Yeah, absolutely. The experience of trying to build a digital consumer bank inside a large incumbent, even though you're in a separate market with a standalone mandate to do so, and then realize that actually it's incredibly difficult to do because of the reasons that we just talked about, gave rise to the idea that look, if you really are going to build new types of banks and really transform them and build better banks, it's going to be easier to do it outside of a large organization than inside of a large organization. And as I said earlier, until very recently, that wasn't true. It's only been true in the last few years that it's been possible to essentially build a bank from scratch, in the sense that you no longer require the big distribution channels. Digital adoption has really changed that. But also your ability to assemble your technology, both as a service that you curate rather than build, but also that you can then host essentially for free in the cloud. It really changes the dynamics of your ability to build a business. And I would say almost if you look at the neobanks that have launched over the last 4 or 5 years, not all of them have had that context, that premise for being able to start. Some have had to sit on quite old technology. Many have had to completely build their own. Whereas actually fintech as a service, software as a service essentially is something that's a reality now and allows you, with the right skills and the right knowledge and the right regulatory overview, you can now build a bank from scratch. And that's actually proving to be easier than trying to do it within a large bank that has all sorts of constraints and restrictions on your ability to change the incumbent model.
I agree with you. And I think you mentioned the cloud, and that's one of the things that was a real game changer, because we would both know that 3 years ago, maybe even less than that, if you spoke to a high street bank about the cloud, everyone was saying, no, we can't go to the cloud. It's all got to be on-prem. Whose cloud? My cloud? Your cloud? iCloud? Which cloud? And now, of course, after we've seen the likes of all the new, we'll call them neo or challenges that were completely cloud-based and micro versus monolith marketplace Java Plus built, everyone's gone, okay, now I get it. And I'm not as worried about the security. I can imagine the conversations with the PRA in the UK, the authority that will help regulate the banks, saying, well, where is this data stored? Well, somewhere in the cloud. Where's the cloud? I don't know. Somewhere in the clouds is the whole point of it, right? So that it is cheaper and you can accommodate the volume. So this, maybe now we can talk about the bank that you're starting.
Yeah. So Pennyworth is the bank we're starting. And we decided as a team, many of whom that I've spent the last years with building banks in Barclays, to go about starting our own bank. I think part of it was the acknowledgement that whilst we had proven that you could build a bank, you had to do it separately. Part of it also was as I said, the structural change in the market. And part of it then was also the fact that the regulatory barriers have been taken down significantly to be able to do it. We know that the problem we wanted to solve was the fact that most people felt that they didn't get the most out of their money. They wanted to make a change. But of course, there was a huge amount of inertia, particularly around the core current account, that people really didn't want to switch and they weren't sure what to switch into. But when you looked at the wider economy and the things they were trying to achieve, both in the short term and medium and long terms, buying things, preparing to buy a car or for a big event like a wedding or to buy a house or retire, the value they were getting from their existing bank, and particularly the personalization they were getting from their existing bank, was just not there. And so there's an inherent demand for that. So what we wanted to do was provide a solution for that where we'd help people focus on what are the goals they're trying to achieve. And then we do the financial heavy lifting. And we do that through a mix of great value products, really effortless experience, and then personalization, particularly via an algorithm, via a recommendation engine, and help people make better decisions without the effort of having to research and spend time inputting applications and so forth. We would actually help them through that process.
And the group that you're trying to work with, the niche in the market for you, because we know that having a community, creating a community is a big part of the expense of a new proposition. And also if the products and the services that you are building and the personalization is personal to this group. So who is that?
Well, we're targeting what we call the aspiring affluent or mass affluent segment. And really, we define that as a demographically or financially with the customers who have incomes over £40,000 or liquid savings of £40,000 and above. I think the problem that I specified earlier is true for all customers. But what we've found again and again is this is the part of the retail market segment that is least well serviced. They are the top 20% of the retail market, but they're not, if you will, wealthy enough to be looked after by private bankers and wealth managers. And so they get the sort of products and digital experiences that all other retail customers get, yet they generate about 80% of the revenue of the retail banking business. And typically their financials are a little bit more complex. Everyone has the same issues ahead of them as, okay, how do I fund this life of goals that I have ahead of me? I have this income and I have these expenses, and how do I, over time, turn that into various forms of borrowing and saving in order to achieve them the best way? But of course, with larger sums and more complex financials, that becomes a bigger problem. Yet the banks were largely servicing this population, either with traditional distribution, or maybe they'd give them a premier service, which was essentially a relationship manager and a gold checkbook. But it wasn't really solving the problem, focused on this population. So we had started looking at this population before. We did the same thing when we went to new markets in Barclays. It was typically this part of the retail market you would start with and you build out. This is what we prove in the US as well, that we could acquire there a $15 billion balance sheet by acquiring these types of customers away from their main banks by offering great experiences and great products. And so that was where our strategy is focused, where we're targeting the aspiring affluent and helping them turn their goals into financial actions in order to achieve them.
Do you think that they didn't know that they should ask for this, or that this was a mechanism for that to happen? And what we're saying that they just took what came their way, do you think as a group people are aware to say, actually, there might be a better way for me?
Yeah, when we researched this, what we've seen is there's a range of answers to that question. There are obviously those that actively search for better value, but they recognize that it requires research using comparison websites, managing multiple different providers of products and having to figure out how to manage that. So they'll typically be people who will be doing planning themselves with Excel spreadsheets or using a PFM tool. They'll be searching lots of different providers and putting maybe a savings account here and a borrowing from here, and they'll apply Value Money Supermarket here. So a lot of effort. And when it comes to personal finances, as much as they're important, the amount of effort that's required to be able to do that and move away from your main bank, I don't think, what we found at least, is that's not everybody that's willing to do that. And the banks, because as we talked about before, structurally high cost base, both in distribution and back end, traditionally have a large number of customers sitting with high margin products, low cost deposits or high yielding loans on their business, have no incentive to really change, nor can structurally change. And as we talked about earlier, really aren't set up because they're set up in silos to change quickly either. And so most people are put up with almost that level of service and that value because there's a natural inertia. And that is exploited then, I think, by these larger incumbent banks that have those structural issues, as we said before. What we did see, though, is it depends also on the product. For current account, the value difference between an incumbent and a new entrant is very small. There's not a lot of interest there. There's an experiential difference that's definitely there, but it's not a lot of experience. But there's a lot of effort required, mental effort required in switching that over to someone else, and a lot of risk associated with all the payments, etc. So while it's actually quite easy to switch, a lot of people will tend not to switch that product. So you see the switching numbers are something like 1% to 2% per annum. And that's universally true. Whereas if you look at the other end of the spectrum, mortgages, credit card, etc., people are much more willing. There's a much more well-trodden path of switching those products. And so what we see is not only does it range across different attitudes to change and willingness to change, it ranges across product as well. And the types of product at Pennyworth that we're focusing on, which are not current accounts, where we're very happy just to use open banking and let people aggregate. We tested that in the US and that works very well, but actually use savings and loans, where if you've got a large amount of money that you want to save to a future event, or you need to borrow to improve a kitchen or something else, then it's worth the effort of going out and say, hey, I want to have some additional value. I'll search online and comparison sites, and I'll place a large deposit with a different institution or take a large loan from a different institution. And what we found is that that's a good place to therefore target customers and acquire them onto valuable products from day one.
In terms of the business model for you, how would it work for you when it's not working for somebody else?
Well, I think part of it's about not trying to win that battle for the current account. I think with such low switching numbers, what you end up with there instead is you have a large number of customers not moving their salary mandate, not moving their actual banking, but actually just using it as a prepaid card, just using it as a payment vehicle. And therefore you end up with a lot of low value balances on a very expensive product to manage. Our focus on savings and loans, so sort of term loans, time deposits, instant savings, means that we can actually price at very attractive rates for the customer, a product that actually, once we book it, is profitable on a unitary basis because we're taking a spread between our savings and loans. It's a much smaller spread that you would get at the traditional big bank, but we don't have all the costs of a big bank. We have a very light infrastructure cost and distribution cost. And so even if we're acquiring a piece of business with a customer, or even though we're acquiring a loan or a deposit through an aggregator site, the cost of acquisition is lower than the value of the product that we're acquiring.
Okay, so we haven't got the hundreds of pounds or dollars that it is to acquire a customer directly and then have
nothing to show for it afterwards.
You don't have a 19th century or a 20th century infrastructure that you're supporting.
Exactly. Yeah, exactly. Yeah.
And how has the journey been? Where are you on the regulation side of things now?
Yeah, so we're still what's called Preapplication, which is one of the great things about, I think, the regulatory environment here in the UK is that you are, as a startup, allowed to submit draft applications before you formally apply, which are reviewed and challenged so that once you come to actually apply, it's a very high quality application and you can confidently move on to build your bank. We started that process in March. We submitted our first draft in June. We're in the final stages of pre-application now, and we hope to submit our final submission in the early in the new year.
And what's the process been like?
It's been actually really good. We were worried, obviously, as we started that process in March, just as lockdown happened, what would be the experience of what had otherwise been, I think, a face-to-face process. And we just moved it onto calls. We just moved it online, and it's worked incredibly well, both internally in terms of obviously developing regulatory documents and reviewing them and challenge them internally, as well as then having calls and challenge sessions with the PRA and FCA. So I think that's been remarkably good. And actually, it's enabled us to keep quite focused, I guess, if everyone locked down and building a bank from their front room.
So you built the bank on Zoom or another platform that might be used in a regulatory environment, probably more like WebEx, where they really spelt embraces in terms of security there. Can I ask you, as people, did you ever think that you would be in this position? If you cast your mind back those 20 odd years, could you ever imagine that you would be setting out to do something that is brand new and very much the entrepreneur side of you versus the banker side of you?
Yes, it's easy to say now that it's always been in me. I was always a frustrated entrepreneur inside a large organization. But no, up until now, I couldn't have imagined doing so, mostly because of the structure, as I said, of the market and the industry. But building a bank was a scale business, both from a regulatory perspective, but also particularly from a physical infrastructure perspective. And so it was always a scale business. I started out my early career in Barclays in M&A, and I was always slightly envious of those M&A practitioners that went from large financial institutions to setting up their own little boutique, because that was one of the few areas inside financial services where you could actually start your own business. But I was in retail. I'd spent a lot of my time investing in building retail businesses, consumer banking businesses, and that was a scale business. Along comes the changes in technology that means that's now possible to do. And you realize quickly then that a lot of the skills that go with that in terms of building and iterating and testing and learning, whilst they live in pockets inside the large banks, those are skills that you really need, but also are desirable to attain. You're not able to do that inside a large organization. I think, though, the team that we put together and the range of skills that we've put together to do this I think that there's always an element of which they were people who were gravitated towards building new things inside the large organization. So those skills or that appetite is there, but I don't think they could have imagined doing so.
And also I can imagine, we always say that if you had to explain to your grandmother what you were doing now for work, right, there might be parts of your family going, what are you doing? Why are you taking us on this journey? There's the whole entrepreneurial journey alongside the banking side of it is you're taking everybody with you. And it is a bit of a leap of faith.
It is indeed. I mean, actually interesting, my kids get it much better than the rest of my family. It's very normal for people just to start an app and start building a bank, and they're happily involved in testing some of the screens and so forth. Whereas the idea that you tell other people that I've decided to build a bank and start my own business does take some going over.
Have there been any challenges or have you had any pushback from areas that maybe you didn't think that you would, that you weren't anticipating?
I think that what we thought was going to be the most difficult aspect was regulatory and going through that time. And that's proven to be quite straightforward. And also the actual process of putting together prototypes and building the bank and launching our waitlist has been, I think, actually much easier than we had thought. What has been difficult is the transition, I think, personally for us, going from people who are typically winning a mandate from a bank and then going out and setting up a bank, whereas now we're bootstrapping our business and bringing in third-party investors into building bank. That's a very different skill set that you need to build to do that. I think also we don't fit the traditional pattern of startup entrepreneurs. We're not 30-somethings in our garage. We're definitely not that. There are some of those in the team, but we're much more of a experienced management team. We're the sort of team that a lot of neobanks bring in 2 years into their journey in order to really grow and scale the business and monetize on the platform they've built. But actually, the ability to build a bank from scratch now is there. And so bringing in that skill set early on, as I just said, has proven to be a lot easier than we thought, but it doesn't fit the mold.
I was just going to say, we're banking on air, as it were, so people can't see that Jeremy looks like he probably, when he says he had all those years in the bank, you look like you started when you were about 12. So you're doing well on the years. The process is not wearing you down or putting wrinkles on your face. So that's interesting to note. And I agree with you. I think, and also with some of the new banks, when things start to get a bit rough, then they bring in the experience. And it usually is in the background, whereas as youth has been pushed out to the front. But then they were also targeting initially millennials. So it was almost, look at me, I'm a mirror image of you. Whereas you are going for what I think probably the average age of the, not entirely, but the average age of the customer will be a bit older. Maybe somebody who's in their 40s, where they have enough of that liquid finance to be able to take advantage of the products.
Yeah, what we're seeing is the population that we're classing as aspiring mass affluent based on the criteria of 40,000 of savings and income is a range that starts obviously as people start their career as young professionals in their 20s and 30s, and then they tend to be really qualifying based on that income. And the behaviors and the needs of those individuals are very different. Of course, most of that population is probably Gen X. And so that's probably a better fit with a lot of, or we can relate better to perhaps with some of those. But if you design a bank for anybody, you start from design thinking principles 101, where you're really trying to explore and understand people and build your proposition around them. So I think that doesn't really require you to be the same as your customers in order to build great propositions for them.
I think this market research and the research into your marketplace so that you are giving back to them what they've told you that they wanted is something that doesn't always happen.
Right. The need to really study and put yourself in the mind of users is critical, whether that's socially conscious millennials or baby boomers that are just used to very different experiences. For us, the biggest challenge really, I think, has been the fact that we're a hybrid of a number of things. First of all, we're a hybrid of experienced consumer bankers who typically work in silos, who typically work in very big, large organizations with functional silos and have years of experience of doing so, but aren't used to actually working in interdisciplinary teams, in sprints, in agile, unless they're in the IT function. And they're used to actually being a product manager who just hands off to an intermediary, i.e. a digital function or a transformation function, all of the change rather than actually being responsible for themselves. So that's part one. There's a very few people, I would say, inside consumer banking that have that type of experience. Similarly, though, bringing in people who are very experienced at that, software engineers, designers, etc., have very little understanding about how does a balance sheet work, how does a bank function, what are the requirements to that. And so it's that merger of those two that makes, I think, a great startup banking team. We're also a hybrid of different industries, if you will, because we're focused on the entire customer picture of how do they improve their finances across their life, which typically gets covered both by banking, but also by investment management. And those are two very separate industries and problem spaces typically, but actually customers live in both of them overlapping. And so you need a different set of skills and understanding about the products that take you from one part to the other.
I think you're right. I think we've seen people try to stick on wealth management advisory onto something that is a current or a checking account and say, oh, just roll over or have a hybrid model. We'll introduce you to X large incumbent. Well, we see it with Marcus and Nutmeg, for example, and now Starling and Nutmeg as well, where they're adding on the investment side for some of their customers. And as you're talking, I'm thinking lots of people having conversations now about the fact that is the pandemic going to push, is this going to be the litmus test for mergers, acquisitions, consolidation, closure? And does that ever come into your mind when you're thinking about the timing of what you set out to do, which you could not have known, obviously, about the pandemic? But has that crept in anywhere, or is that completely not a thought for you?
The timing of coronavirus or the impact of coronavirus on our timing really hasn't been that material. I think partly because whilst we've had to think a lot about it as we've been going through, there's also an appreciation of launching a bank takes time. We'll know a lot more about it and what the impact of the economy is by the time we launch our banking products later on. I think what it does question are a lot of the models that you've seen that require constant capital injection to keep alive. Back to the question that we were talking about earlier, because the underlying models perhaps are less sustainable or not sustainable because they're dealing with products that are unprofitable at large scale customer bases. There's been a few examples, I think, of businesses that were structurally unprofitable but have become profitable only because we've had a lot of government guaranteed debt suddenly issued that they've been able to benefit from. But there are other models that are really showing the strain of running essentially a marginally loss-making franchise. And then we're seeing essentially a return to ways of trying to drive revenue from transactional banking, which is pretty old in a way, which is bundling and premium accounts. So asking people to actually pay for services that you add on to banking, like insurance and other things, which are probably not worth the value of the package that they're paying for. That premium is being used to cross-subsidize for the business you've got. Much rather, as we're doing, focus on a business where intrinsically the cost of acquisition is lower than the value of the product, both to the customer and to us as a bank, that we're a traditional bank in the sense of it's a balance sheet spread business, and we don't therefore need to charge for all the ancillary bits and pieces. Our planning experience is completely free. We're not trying to have a banking business and then throw on investment business on the side. We think goal setting and planning is an intrinsic part of planning your financial life, and the products that sit behind that can be banking products, can be investment products, and actually that shouldn't really matter. It's more about how are you actually pursuing the things you want in your life. And if we focus on that type of model, then we shouldn't have to worry about those low-scale economies that some others are.
I couldn't agree more. Every time we open a digital page, as it were, there is something else that feels a little bit like this is a plug. It's a plaster or a Band-Aid, depending on where you are in the world. But everyone's getting on the same bandwagon, and so we'll do that. And now I saw another launch of paying for a premium service and all the variety of different types of cards, from those that biodegrade to those that are a precious metal or a similar metal, and all the other things that come with them. We have seemed to gone back in time in this way. And that's incumbents and challenges. I would love to say that when you have the license and you've raised all your finance and you've worked with all your partners, that we would come back and see how that's all starting to work out. So that's probably not too much further down the track if you're already halfway through on the licensing side. So it just remains for me to say, Jeremy Takle, thank you very much for being with us today at Banking on Air, and we will see you again when the license comes.
Thanks very much. Look forward to it.
Thank you to everyone who's been listening and who joined us. We'll see you on our next podcast.